In part 2 of The Art and Science of Smart Investing, Joseph and Tom examine how fear and greed derail investors, and how a clear, disciplined process keeps you from fighting your own instruments.
We all know, I hope we all know, that as humans we can be irrational at times. And we know markets can be irrational.
Right.
So I know you have some stories and lessons learned that you'd like to share, which played a big role later in your life when you've come to build Dorsey Wright Associates.
Yeah, I mean, there's some strange kind of things that happened to me when I was, it has to do with believing your instruments. And
Believing in the system.
In the system, yeah. I mean, in what you do. In other words, how do I mitigate risk in the process in risk mitigation in your portfolio? Right. I got to stick with that.
Right.
Well, I was flying a Cessna 150 back when I was about 22 years old, and I didn't have any money. You know, I was E3 at the time, but I put all my money into flying. You know, that's what I loved. So I'm coming back from Palm Springs, and keep in mind back then in the Cessna 150, so many years ago, you had an Omni, and you had a compass, and then you had a sectional map on your lap, and you're looking down and say, oh yeah, that train track looks like it coincides with this train track. Yeah, okay, good. That's the way it was back then. Hey, you need to find ocean? We're gonna find ocean. What's blue? Compass says, you ain't going that way. Net result was, I ended up flying into Mexico by accident. I had no idea. All of a sudden, I find myself in a video game. The mountains had changed, and I'm like, oh my God, I don't even have enough fuel to get over the mountain to look down and see where I am. So I knew I was in deep trouble. And my right tank went empty. My left tank was almost empty. And I had to then land in the horse pasture. That could easily have been my last day of my life. Easily. I didn't follow the instruments. So, and what happens in the market when all of a sudden things are going bad? You know it, and you're looking at the charts. Some things that we know suggest to us that the probability is going to be lower prices, more sellers than buyers. We are able to operate. You got to be cool about it, though. You can't lose. You know, you can't lose your mind over this thing.
Yeah, no, I just jotted a couple of notes. I love that story, Tom, because that happened early in your life, and there's a lot of similes to investing. And there's such a thing called behavior finance, managing your emotions, having a system, a process, and sticking to it, right? I mean, I just wrote this note down. You had a confirmation bias, right? Seeing what you wanted to see.
Yeah.
You were looking at the blue sky. So you were overconfident. You ignored your instruments, everything you learned, and you said, I know I'm going the right way. The hell with my instruments, right?
That's exactly right.
You trusted your gut over the data.
That's right.
That happens in investing all the time, right?
Yes, absolutely.
Right? Recency bias. Thinking that the last move in the market is going to predict the next move. It doesn't work that way.
No,
right?
It doesn't. It doesn't.
Right.
Absolutely.
And that's what point and figure and marrying it with relative strength is all about. Right?
Yeah. All I had to do is keep turning that plane to the point where it said west, which is where I wanted to go, and I'd be going in the right direction.
Yeah.
But I went with what my eyes told me. That blue you see out there, that's ocean.
You're one of the great storytellers in our industry, and I love the lessons that you've learned from those experiences and how you use those lessons and applied it to Dorsey, Wright & Associates, and the systematic approach that you found to have really, really great success using point and figure and marrying it with relative strength.
Exactly.
It's no different than a value manager, a large cap growth manager. They have a process in place. Small cap manager, they got to follow that process.
Yeah, but see, people had already created this.
What's the New York Stock Exchange bullish percent?
That's my most important market indicator.
Right.
That tells me whether I have the football, or I don't have the football.
Even today.
Which team's on the field?
Even today.
Offense or defense? Even today. Absolutely. And what is that? Well, it's extremely low technology. It's a calculation of the percentage of stocks on the New York Stock Exchange that are on point and figure buy signals. Well, what does that mean? Well, when you look at the chart on a point and figure chart, column of X's that exceeds a previous column of X's would be a point of where previously selling pressure came in and forced it down, but now it comes back up to that level. The selling pressure is not there, it exceeds it. Now, when you look at that and say there's 2,000 stocks here, if we're at 70% of the stocks in the New York Stock Exchange are on point and figure buy signals, that means you can't be on a buy signal without more buyers than sellers. So people are fully invested. So you're up at that level, and if you come to your customer and say, Mr. Jones, I think we ought to buy Microsoft, I'd love to do it. I'm fully invested, though. I don't have any more money. And that's what happens up there at that top. People are already in 100% of what they're going to be putting in. They don't have much money left, and that's when the trouble begins to happen. One stock gives a sell signal, two stocks. Next thing you know, investor sentiment changes, and it begins to rain. When you come to the opposite side of the equation, and that's simply a chart of 0 to 100%, you come to the opposite side at 30%. That's when people feel like throwing up in the trash can. The sweat is beading up on the forehead. They're losing in their portfolio. Gets down to 30%, everyone has pretty much sold that wants to sell because it can't get down to 30% without selling pressure. And a column of O's that exceeds a previous column of O's is breaking support. And once you get down to a point where there's only 30% left in that chart, the only stocks people have left is where Daddy gave them the Coca-Cola at $2 a share, and they're holding that for life.
And that goes back to your old simple theory about the irrefutable law of supply and demand. In those drawdown periods, there's much more supply than demand.
That's it.
Right? And then when the supply begins to evaporate and demand takes control, you put the offense back on the field.
Precisely.
And you can see that in a pattern on a chart.
And we used to call it, do you have the football or don't you?
Yeah.
If you don't have the football, what team do you put on the field? Defensive team.
Yeah.
If you have the football, you put the offensive team.
Yep.
And what tells me whether I have the football or not? The bullish percent index. Is it in a column of O's, column of X's? And then which part of the field is it in? Some simplistic things like that will help you become more aggressive or less aggressive.
Yeah. We've been through the wars.
Yeah.
We've been to through the seismic shifts in our industry. We've even been in the room developing solutions and products. We had a voice at the table with many of the Wall Street minds through the years. So tell me, when you go through October 19th, 1987, when the S&P 500 was down, I think 22% in one day, right? We've never seen that again. Hopefully we never see it again. That's a scary time, Tom. What do you tell people in times like that?
What I tell people in times like that, because I had just started my company 10 months earlier.
Yeah.
So the reports that I would write every day, it was September, early September, the New York Stock Exchange bullish percent that we just talked about reversed into a column of O's from above 70%.
Yeah.
That told you there's trouble in the field. Defensive team must go on the field. Well, what does defense mean to you? I mean, I don't buy any more stocks. Maybe I sell what I have.
If people wanted to look back at your research reports back then, in other words, they'll see that you documented that. You said that in September. It's all
documented.
There.
Oh, yeah.
It's all there. It's all there.
It's all there.
Right. So, Tom,
I'm not sure if you could find it today, but
so I'm sure you could. I mean, you could find anything today. So again, now it's all these years later, okay? Mm-hmm. April 9th, the beginning of April 2025, people thought the world was coming to an end because of the tariff news, right? People wanted to jump out of the boat, right?
Yeah.
Stick to your plan.
Yep.
Stick to the system.
You have to.
It may be a little bit painful. You can't get out of you may not be able to get out of the way of the whole thing, right?
But a lot of times you can. You take 2008 for once.
Yeah.
2008 was a killer for most people.
Yeah.
It was a wonderful year for me.
You were in small caps, mid caps.
Well, no. We were in no stocks at all. Yeah. Dorsey Wright has what's called the dynamic asset level investing. In other words, it looks at large sectors, U.S. equities, international equities, fixed income, foreign currencies, all the way down. Six different categories. You can only invest in the top two. That's the rules. The top two you can invest in.
So there's always a place to be in the market, right?
Yes, that's right.
When other things are not working out. If you have Solus barometers, if you have a system that is time-tested and proven, you stick to that system. Mm-hmm. You know, it may be not going to get you out of all the pain, but it's going to you're going to be a lot better off. You can cut off some of the decline. I'd like to get back to the behavior part of it. Okay, mm-hmm. You know, the story that you shared at the beginning of this segment. So, behavioral finance, managing advisors, being the financial coach. That's what they are of their clients. Because even the best clients will become emotional at times. I saw it in early April of this year. Right.
Yep.
You know, your job is, as an advisor, you're their coach. You hopefully put a good plan together in conjunction with their client. They know what they own and why they own it, okay? In those turbulent markets, it's your job to basically walk them through the difficult times, because I don't care what manager, how successful a manager is out there, they're going to run into periods of disappointing times where their performance is lagging.
Absolutely.
You know, nobody gets it 100% right. As a matter of fact, if you get it right 4 out of 10 times and know how to manage the risk, the bell curve, right?
Yeah.
Or it's hang in the middle, try to wall off the left side where the big losses are. And every once in a while, the middle moves over to the right and you have the big winners. And you understand those things. My feeling is that, but I noticed in benchmark studies that we participate in that those advisors that incorporate behavioral management into their practice do far better than those who don't. Mm-hmm. So, and Vanguard, and I think it was Russell, they've done these studies, okay, the worth of a financial advisor, and those advisors that become the financial coach, because advisors now do much more than what they did when you and I originally came into the business,
right,
as stockbrokers. Okay, and I'm, you know, before I went to the Philadelphia Stock Exchange, I managed a 30-person sales team of stockbrokers. So they do all the planning. They do cash flow analysis. They do the tax planning for them, and they do the investment planning for them. So what those studies have shown is the advisors that incorporate the behavioral piece into their practice is worth it's worth 200 basis points, 200, 250 basis points, because they keep their clients out of trouble. Mm-hmm. They keep their clients from flying their plane that's supposed to be in San Diego and lands in a patch in Mexico. Right? That's not where you're going.
That's right, to keep them from doing that.
Yeah, so the behavior piece is very, very important to an advisor's practice, because investing is emotional. Tom, everything we're talking about here today is important to the principals at NewSquare Capital. Our portfolio managers, all of our portfolio managers, we have 4 senior portfolio managers. They all have different philosophies, but we collaborate. We have a value manager. We have a macro manager, fixed income manager, and we have Brian Kirk, who leads our team. Mm-hmm. He uses technicals, he uses point figure, uses relative strength, uses momentum. He leads with that. right? But we all collaborate. So there's a risk management component in everything we do. We have a plan and a process, and we follow the process. And the long-term outlook, the long-term results of the process that we use in a majority of our portfolios either at their bench or do better than their bench over the long term. And I want to talk about long-term investing, right? Because you always like to say what you learned, and I'll give you that opportunity. Well, before I finish, why don't you say? Go ahead.
What I was thinking was
The best advice you got, right?
oh, yeah, the best advice I got
Was from?
was from A.B. Jones in my first year at Merrill Lynch. When I finished my first year, it was a whirlwind year. I mean, it was like, I'm on Wall Street. I'm a trader, man. Let's rock and roll. Yeah. He said, Tom, let me tell you something. He said, ain't but one way to make money in the stock market. I said, how's that, A.B.? He said, slowly.
Yes.
Then he turned around and walked off.
Yeah, and that's the truth. I mean, it takes patience. There's a financial research firm up in Massachusetts called Dalbar, and they study investors' behavior on a 1 year basis. Well, actually on a 1 month basis, 1 year basis, 2 years, 3 years, 5 years, all the way up to 30 years. And the results are the same every time they come out with the report.
Is that right?
The average investor holds their portfolio for 3.7 years. It's not enough time. Okay? It's not enough time because they chase performance. They're overconfident. So at NewSquare, it's a hallmark of ours. I mean, they can take their money anytime they want. In April, they wanted to sell out of the market, they could sell out of the market. But our job is to coach them. Step back. You have a plan. Stick to the plan.
Right.
Right? And we've convinced a lot of investors in April to stick to the plan. And they stayed with the plan and they're better off for it. My point is, if you want to become an investor in today's market, give yourself a 7 to 10 year time horizon if you're a growth investor. It's not saying that you can't put money to work for 2 years or 3 years, but you want to be very conservative because I haven't met in my long career, I don't know about you, Tom, anyone that has the ability to predict the market over the short term, midterm, and long term. Am I right?
I've met a lot of people, but not that. No.
Yeah. So we'll close with that, and we look forward to the next segment. Stay tuned.
Next, in Part 3, they shift from behavior to the tools that enforce discipline, including relative strength, diversification, and rules-driven allocation.